Welcome to a short introduction to a real estate portfolio financial model. Before we start, if you'd like to see more videos from us, please push the subscribe button. The purpose of this model is to simulate the build-up of a real estate portfolio, and we want to simulate the expected financial performance. The idea is that we include a set of properties which we're going either to acquire, to develop, to renovate, or other activities to include in our portfolio. And we like to simulate how our portfolio behave when we acquire these properties. This financial model is a model from efinancialmodels.com. I will include a link to the description below. So let's get started with our analysis. The first thing to do is that we only will focus on one property. So we will exclude all other properties and we'll just focus on that. And we will double check now that if here in the rental income build up, you will see it's only one property included. We then also shortly check the general assumptions. So there is no other income assumed. There is no some chance. There is no other overhead expenses assumed at the portfolio level, so it's the pure property. And when we look at the uses and sources of funds, so basically it looks like we have to spend these are just example figures. We have to spend 13 million for the property. We can, in that case, get 80% debt financing, and then we have to fund the rest via equity. All this data we have collected before, and we have entered this on this property sheet. So we collect data such as the leasable area, what type of property this is, when are we going to acquire this property, so we can change the time plan, or we could move this from year 1 to year 2, and depending on that, our scenario we can adapt and update as we like to. Let's move this back here. Then we also say when we are going to exit the property. This depends on the scenario. In that case, we have here a 10-year hold. So let's say for this single property, we would only plan to hold this for 5 years. So in quarter 20, we would plan to exit. And then basically the rental incomes will stop at the end of year 5. And then if we continue, we have to set how much it will cost for the acquisition, how much it will cost we have to spend on additional investments to improve the property and enhance its lease value, how much debt financing we can obtain. In this case, this depends on the property type, residential or commercial. So this residential, we expect 80% debt financing, and the rest we have to fund in equity. We also enter what's the target rent roll and OPEX, so that we can estimate what will be the net operating income to obtain from this property. And also short analysis, if we look at the cash flows, this property should produce positive cash flow, have positive yields, and once it's ready for exit, we would expect this cap rate that the property will have this value. So all these parameters are set. This looks good. And then what we now can do is to start our analysis, and we see here the business case. So we get a property with these yields. If you look at it from a buy and hold perspective for 5 years, this might be a bit tight. This might not be the best scenario. The reason is mostly, if we look here at, let's see that, here it is. If we look at the cash flow statement, we pay 13 million, so we should at least get the same value out when selling. In that case, we have to recalibrate our assumption. There was in that case, what we do is we correct the assumptions. In that case, let's reduce a bit initial acquisition costs. We look again at our scenario, makes a bit more sense, and then we can also look at the expected return. And you see, because of leverage, we can get attractive returns. This is when looking at one property. Now, the analysis can become much more interesting when we include all the properties in our portfolio. So the way to do that is to basically select which ones of these properties we want to include. So let's, for instance, include a series of 15 properties. All the data is entered, there are different types, and we're going to acquire these in the course of basically 4 years. And now let's have a look at the rental income. So the scenario is that every year we're going to acquire this. There are some properties acquired in the last quarter, so the rental income will only show up in year 5. And here we already have an exit, so maybe in that case we would exit at, let's say, at the end in year 10. So we have these cash flows, and then we have the build up of this rental income. So we can see how much rental income we can get. And when looking at the charts, we can also see that here basically we will have a portfolio with this property with about, in that case, 200 million property value. And we are gonna have a look again at these yields. Now the thing is that this portfolio will also require some work. So we have maybe to simulate some costs at the portfolio level, for instance, some management fees. We could say 2% of gross assets. We again look at the yields and returns. And we can also see again on the cash flows how this will work out. Now, of course, we can further change the assumptions. We can include other properties. We can also play around with the management fee, put it higher or lower. We can also assume only a partial exit. For instance, we could say that some of these properties will be sold maybe earlier. So we can just overwrite this and basically play around with our portfolio so that we can get a better view on how this portfolio could develop. One other way to look at it would be, we have here a cash balance which will build up. So you see we invest here over the years in real estate, and then here we stop investing. So here the cash starts to pile up. So we have not used that cash. So the question is, how about we are using this cash? There's a function if we can either go and define additional properties to be acquired or to be managed in our portfolio, or what we can do is we have here an option to simulate an auto reinvestment. So we could do that. In that case, we have some conditions to meet. So we just check through. So cash reserve needs to be 0. The funding period, in this case, we start too early with reinvestment. We need at least to start in quarter 30. So let's move this a bit later. Okay, we could do that. That would still work, still green. That looks good. In terms of the cash required, let's shortly go out here, and here in this scenario we need 40 million. So let's say this scenario we would start with 40 million. Voila. 1 0 more. Include. Okay, here we go. In minimum cash on the balance sheet, we might get a bit low, but it still should be sufficient. I think there's 1 quarter. If we look at that, so we can here track on a quarterly basis the cash position, and if it gets very low, you see here it's very low, we could either add a cash buffer or raise a bit more funding to be on the safe side, or maybe we can also move around some of the acquisitions. Then let's do that, and then you can see now in that scenario, that's the reinvestment scenario, what will happen is that basically from year 8 on, Everything above this threshold will be invested in additional properties. And then you see these, this one is CapEx. You see this is all going into CapEx. And then in that case, the portfolio starts or basically continues to grow. So we invest all this cash, and this will have effect here on the yields and on the IRR. So I hope this gives you an overview what this model can do and how you could simulate your future real estate portfolio. And also I hope it gives you a better idea how to run this analysis when analyzing a real estate portfolio. If you like this video, please give it a thumbs up, subscribe to our channel, and visit our website efinancialmodels.com. A link to the model is included in the description below. Thank you for watching.